We're going to talk about some numbers, obviously, and we're going to be talking about the economic decisions between the two. We're also going to talk about some general topics, some current issues. At the end, we're going to talk a little bit about the new tax law. I know that's not specific to corn and soybeans, but it's part of what I do, and it generates a lot of interest and controversy these days. It's one of those particular times in our lives where taxes are actually interesting. So we're going to spend a few minutes at the end talking about it. Before we get to that point, however, we're going to talk, and sorry about that picture. Harold said I had to put the picture on the second slide, so ignore that and focus on the text. Current issues that we're all kind of thinking and worrying about as we're commodity crop producers or in an industry related to that, right? And we've got a lot of these things that are kind of frothy right now. We're not really sure what's going on and where we're headed. Our government these days, I think it doesn't matter which side of the aisle that you're on. It's a little bit like a reality TV show, right? It just grabs your attention each day and kind of wears us out at times, right? So trade, we're following that right now. What's going on with NAFTA? Also, what's going on with tariffs? And will there be any repercussions if we do see some of these tariffs come online? Is it all blown out of proportion? You know, will we actually have some impact on some of our prices down the road? Right now, it's not seeming to have any impact, right? We're not seeing any real negative impacts to corn and soybeans, and might that be something that happens on down the road? They've been talking about the renewable fuel standards, right? You know, capping that RIN price at 10 cents a gallon. Is that going to, really hurt blending? Well, perhaps. Some of the articles that I've read would indicate that it will decrease the ethanol blending, maybe even eliminate some of the biofuel soybean diesel blending. So that's something that we're going to continue to watch. What kind of repercussions is it going to have for all of our commodity crops? And then the balance, as you start to evaluate your kind of final decision making for this upcoming year, and you probably made most of those decisions in terms of crop mix, but will some of these events affect your decision making from this point until when you really have to make those final choices? Farm bill, that's something that we've talked all winter about, tried to make everybody aware of. Hopefully everybody's aware that if we don't write a new farm bill, most of you in here are likely going to see little to no ARC County payments. And we know about 90-some% of the acres in Ohio signed up for ARC County. If you had PLC, there's going to be little to no ARC County payments on corn and soybean base acres. Now, there will be some on wheat base acres depending on the county that you're in, so those of you who retain some of those. But right now, it looks as if we're really going to be, it's going to be probably very small chance of actually getting a new farm bill written before the next midterm election, right? I think we look at all the different business that they're trying to do between now and really probably May or June. As we look at the time period when they start to, what do they start to do here in the summer? Well, if they haven't already started the campaign, they're going to start campaigning pretty soon. And that kind of eliminates some of the things that we might hope for in terms of writing a farm bill. However, the one little bright spot that we have with farm legislation and ag and food legislation is this is one of the areas where they tend to work across the aisle still. So there may be a little bit of a silver lining, perhaps a little bit of a bright spot there. I'm a little pessimistic. New tax law, we'll talk more about that. We're still trying to sift through all of what's going on. We'll talk a little bit about the co-op deduction and all the controversy that's creating. And also interest rates. This is something that is kind of percolating beneath the surface, but it will impact your bottom line. And we expect interest rates will probably take another move up this next year. USDA projections, as of their Ag Outlook meeting February 22nd, they're projecting right now about 90 million acres of corn, 90 million acres of soybeans. Okay, about level. Now that's that's about 3 weeks old now. Prices have moved a little bit since then, and even some price relationship has moved in terms of corn and soybeans. So, what's going to look like when we see the end of March prospective planning report, and we're going to see what actually producers are saying they're going to plant. So we'll get a little more information, and then we'll trade on that for the next couple of months until we start to see weather patterns and weather issues start to show up. As long as South America doesn't continue to have major problems, they're already helping to support the crop prices where we are right now. You hate to wish bad things on people, but Argentina certainly is buoying our prices at this point. Okay, so what's going on with prices? I just got a little bit on prices, but these are the last 3 months for corn and soybeans. These are soybean prices, and you can see the leg that we've taken up here in the last few weeks. It's been pretty dramatic. And, considering where we were, and we were kind of stuck in a real sideways and almost negative pattern there for a while. And our prospects in terms of profitability for this upcoming year we weren't too excited about them, to be honest. Now things are looking up. And so this is something that as we kind of move into our planning window here in the next month, or the beginning of it at least, we've got some possibilities. Should we lock in prices? We've heard that a lot, questions that are coming across. Well, there's a lot of risk out there, right? I'm not saying that this is the exact moment. I don't spend a lot of time on this side of the kind of the profit picture. That's other economists that follow that pretty closely. But there is some possibility. We have some risk in the picture right now with all the things that we talked about at the beginning. So perhaps at least beginning to lock in some prices. Corn, a very similar story. We've seen that upward trend here in the last 3 weeks. So what's going on with all of ag, the entire sector? Well, we have seen a steady downward movement in net farm income over the last several years, really since that high profit, high margin period for crop producers between 2006, 2012. We had a pretty good run there, right? Since then, fairly steady declines. Not just crop producers, dairy producers have suffered since 2014. Some of the other livestock sectors have seen some ups and downs. The expectations for 2018, as of that outlook meeting in February, was about a 7% decline in net farm income for the U.S. So the expectation, at least at that point, was probably not a rosy picture. Right? We weren't really expecting anything grand. We saw the prices. We knew what the futures were looking like. But, since then, we've seen prices rally a little bit. We don't know yet how the whole livestock sector will play into it. It's been relatively strong, except for dairy prices. Everything's kind of held their own. So we'll see. But this is kind of where we stand right now in terms of net farm income across the whole sector and the projections. What are prices looking like, and what's the contribution of the revenue side to what's going on in the sector? The first two sets of numbers over here on the left, we've got corn and soybeans. You can see corn, it's taken a step down from 2014. That's the red bar. And a lot of that has to do with actual acreage. There's some price in that number, but some of that has to do with acreage. And soybeans have been kind of up and down. Some of that's been fairly resilient in soybeans as far as gross revenue, mainly because we've added a few acres since those early parts of this decline in margins. Okay, what's soybean prices look like for the last 20 years? This is more of a long-term look, and quite a dramatic increase in that period, right? We've got right here, the top where we had those high margins, where we are now. And what are we stuck with? Well, we're stuck with a cost structure for most of you that's still reflecting these high prices, especially as we look at land rents, seed costs, even fertilizer and chemistry. all those major costs that we are have to absorb, all those things are as a result, these high prices that we experienced. What's corn look like? Pretty similar. What did we see here? Well, we've got this recession, 2009 recession, but 6 and 7, 10, 11, and 12, and this really locked in the rents, the land prices that we're seeing right now that we have to deal with. Seed costs, pretty dramatic increase since 2006. This is the Illinois and the USDA data in terms of corn seed cost per acre. Now, the increases had something to do with genetics, better genetics, more traits. Some of it was just capturing margin. Those seed companies, there was a lot of margin there. They could capture a little more margin. It's flattened out a little bit since then. Global acreage of corn has pretty much flattened out. So these companies, they're having to re-strategize a little bit. There's still a lot of traits that are kind of coming online, but most of that's kind of run its course. This new Extend soybeans, that's a new player in traits, but for the most part, we're still dealing with the same traits that we had, 10 years ago. So we're starting to flatten out. I'm not expecting this thing to start to decline anytime soon. I think the most that we can hope for is a fairly flat seed cost here in the next few years, both corn and soybeans. Fertilizer, this has been up and down. We're competing with other uses too. Fertilizer, some of these products are used in industrial uses, some of the parent product or the base products of these. We've had some potential, at least in the last 6 months, for some bargains perhaps on nitrogen, at least compared to where they were a year prior. Ammonia, 28. Late summer, early fall, they were a little bit lower than what they were a year prior, so there were some opportunities. But overall, fertilizer costs about the same, a little bit higher than where they were a year prior. So, one more increase in cost for those of you who are producing. Energy, this is one that as the global economy has continued to improve, the rest of the economy, global economy, has started to catch up with us. We've had a pretty strong global economy here in the last 2-3 years. What's happened since then? Well, Europe wobbled, Asia and parts of Asia, China. They really took some time to get ramped back up in terms of their economy. They're finally starting to catch up, using more energy. So some of this is demand driven, but we're going to see increases in energy costs likely in 2018. Crude oil, maybe 10-15% higher. Some of our products, 8-10% higher. Propane, we've got on the upper left-hand side, this is the stocks in the U.S. This is the 5-year, this kind of gray band that you see here, this is the 5-year range in propane stocks in the U.S. in million barrels. This blue line is the current year, where we stand in comparison to the last 5 years' stocks. So that's going to give some price pressure, some price signal. If we're kind of on the high end of the range, we're probably a little more flush with propane. Prices are going to tend to move a little bit lower, and the opposite's going to happen. We're seeing where we were a year ago, and this is the last few months, this blue line. So we're a step higher than where we were. Not quite the propane deals that we were seeing. We used a lot of propane last fall, in agriculture, drying a lot of corn, more so than what we did the 2 years prior. So that has put some pressure on the market. We've had a little bit of cold weather this year, maybe a little bit more than we did the last 2 years across the Midwest and the Northeast. So kind of wrapping everything together, what are we expecting? This is no revelation, I know. You're all keenly aware of what's happening. You've probably already done a lot of pricing for this year. Seed costs probably moderately higher. Depends on whether you made some switches in your seed mix. Maybe you went to some non-GMOs, perhaps some older genetics, maybe different seed companies with lower price points. Everybody's scrambling to find some cost savings. Just make sure that you're not doing it and sacrificing that yield that would have more than made up for that additional price. Now is the time to really look at all the survey data that's out there. We're encouraging everyone. I'm not an agronomist, but there's a lot of survey data out there, not just OSU data. Your private companies, doing your own research is going to be probably beneficial when you're trying to make some of these seed choice decisions. Fertilizer, it's going to be a little bit higher. Same with chemicals. These generics have helped keep a lid on things, but you're using more product. That's something that I'm aware of, and I don't follow this nearly as closely. Machinery and equipment depreciation. We continue to ask this question. We look at all the data that's out there. Trade-in values are lower relative to where they were 5-6 years ago. You were trading in equipment probably a little more readily back then because secondary markets, those trade-in markets were stronger. So your effective depreciation, well, it was a little bit lower. Now it's going to be a little bit higher. So when you're looking at capital replacement, make sure that you're factoring that into your decision making on trade-ins. So, okay, we've kind of put all this together and we look at the budgets. Now is the time where I'm going to really challenge you to stay with me. Don't fall asleep. Got a lot of numbers that I'm going to throw up at you. And hopefully they're not too small. This is a glimpse at our crop budgets that we piece together each year with a group of us and try to get kind of a typical corn acre, a typical soybean acre in Ohio. We have to make some assumptions. This corn budget, it's a conventional tillage situation, about a 2,000 acre farm, 50-50 corn soybean rotation. Some other things that we have to make some assumptions on. We're using ammonia as far as a nitrogen source. The soybean budget, sorry, this is the soybean budget. The soybean budget that I'm showing you right here, this is a no-till budget. This is assuming a Roundup Ready GMO system. Okay, so no tillage in this system. All right, so just so you know in terms of comparisons, these are not going to be your numbers, obviously, so continue to challenge you if you haven't already gone through this scenario, this process of doing your own budgeting. Start putting this together, and beyond just in your own head or the back of the envelope. I still challenge my dad and my brothers to do something a little bit more than the envelope, but sometimes that's a good start. But what are you thinking in terms of yield and price? That's kind of where we start. What are your expectations for average price for soybeans and corn for this upcoming year? So what we're looking at, a cost structure that's not going to be yours, but, just bear with us for a little bit, and I'll hopefully share with you at least, what the comparisons look like for corn and soybeans at the present prices and trend yields for Ohio. That's what we have up here. That's what we're using for both of these budgets. So, okay, we take a look at soybeans and we're plugging in 50 bushel beans. This column right here is kind of the average yield scenario for Ohio. This is more of the high-end yield, the 60 bushel beans. I put in the November futures price as of, I think, the close yesterday, 10.44. Okay, I know that some areas there's going to be some negative basis. Basis isn't going to be as strong, so you've got to plug in something that's a little more realistic perhaps for you. So 50 bushel, 1044, returns down here, return to land 142. All right, returns to variable costs. Many of us think this way. We think about covering our cash costs, our variable costs, and then what's left over, that's for overhead. Contribution margin if you're a Purdue graduate. If that's the language that you think about, what's left over. So that number, 320, returns to total costs. Those numbers don't look pretty. We're assuming, we've got to cover machinery and equipment, land, and we got to pay ourselves a little bit. So we're already assuming family draw or ownership, that value coming back to you. So we plug that number in as well. So the number doesn't look too good yet. Negative number. So, but how to compare that? We're going to compare that to corn next. 50 bushels, where do we get that? Well, that's a long-term trend yield for Ohio, as I mentioned, from 1970 to the present. Okay, is that too long of a time period? maybe you're going to be looking at a shorter time horizon, and I'll share with you those numbers here as well. Corn, right now at least, as we look at all the different price signals, our cost structure that, between the two that we have, and, the price point that we have, 405 December futures, I think, is about where they closed yesterday. Trend yield for Ohio, 167. Returns to land doesn't look as good right now, around $71 an acre. If we go backwards and we look at that soybean number, 142, almost double. That's assuming we're covering all of our costs. It's going to look a little bit different as we look at just covering cash costs, however. Okay, so current soybean corn price ratio closes yesterday, November and December futures, 1044, 405, around 2.57. Okay, historically, what do we looked at as far as kind of that break even where we start to make decisions? Yeah, well, the literature, most of it's going to say, at least the older literature, around 2.5. And then we have to start to really look at our own numbers, make sure that we have some idea as far as our relative yields. It's going to be important on each of your farms and fields. And I know that for most of us, we're pretty locked into a 50-50 rotation, or for those that are still growing wheat, maybe a 2-2-1 type of a rotation. But we're still, we're pretty locked in no matter what this price ratio does, right? It's got to get pretty extreme for us to change wholesale in terms of our acreage. It's those marginal acreages that I think we're going to be making some decisions on each year based on this ratio. What's it going to take? Is it going to take 3.0 for you to move massive acres to soybeans, or 1.8 to plant everything to corn? I don't know. It's going to vary by farm. But let's look at some other numbers here. What soybean corn price ratio do we need to have just to break even on variable costs? So what's that corn price need to be to move it to competitive territory with soybeans? 1044 with beans. What's the corn price need to be just to cover our cash or variable costs right now? At least our cost structure that we have. Okay, so we've got soybeans, 1044, returns to variable costs. What do we have left over to pay overhead? $3.20 an acre. It's the same set of facts, 50 and 1044. Corn, we're going to have to move that price point to 416. It's a 405 right now. It's going to have to be 416 before we get returns to variable cost at the same level. So right now, at least if you believe our cost structures and they match up relatively well to yours, and they may not, we're a little out of whack right now. Beans are a little bit more competitive. The prices are arguing a little bit more for more bean acres. Okay, so what's that price ratio? It's around 2.51. 1044, 416. Okay, so what are we going to need to cover all of our costs? Okay, we go back to this and we look at returns to total cost. These are negative, 49 to the negative for beans. For corn at 416, if we were to get to that point, what does that do in terms of covering our total costs? Well, it doesn't compare. It got us equal in terms of our cash or variable expenses. But a corn acre, well, let's be honest, it takes a little bit more machinery cost typically, if we're being real honest about it. A little bit more time, especially if we're using tillage. We don't always think that way. Oftentimes an acre is an acre, you're just trying to generate gross dollars. But, especially if you're using a lot of tillage on corn acres and not so much on bean acres, you're using more equipment, if you will. You're depreciating a little quicker. Yes, sir.
Why don't you, typically we take out beans at 13 or less, or close to 13, but corn you don't typically take out 15, 15 and a half.
We do. Yeah, it's not included here. There's some of these numbers that are kind of behind this that aren't. The only reason I'm not showing them is because it would get too crowded. But we do have drying costs in there for a corn acre. It's not being presented is all. I'm not presenting all the different costs. I'm only showing certain ones. So if you want our full budgets, we have those online. It's a pretty lengthy Excel spreadsheet. I just couldn't throw all the costs up here and it be legible, readable for you. But yeah, all the costs are included in the totals. I'm just showing certain ones, but the totals do include all the ones that are kind of behind the scenes that you're not seeing presented. Yeah, good question. Should have clarified that. How's that working? I better turn it over, huh? All right, is that coming through better? Yep, okay. That'll give me a chance to walk away here. So corn, if we look at that at 416, we're not covering everything to the degree that we did with soybeans, right? We've got a little bit more machinery costs, a little bit more labor and management, if you will, a little bit more costs in terms of hours. So if we're going to be fair to these and fair to our analysis, we should consider a little bit more overhead cost to a corn acre. And at 416, we're not yet covering all those differential costs. So what soybean corn price ratio do we need to cover all those overhead costs that a corn acre, additional costs that a corn acre is going to incur? 1044 beans, we go back to this again. This is the same numbers that you've looked at. 1044, 50 bushel. It's going to be returns to total cost, $49 to the negative. We're going to have to go all the way to 450 corn. Okay, if we're going to cover all those additional overhead costs. Now your numbers might not be exactly like ours. They certainly shouldn't be. But just to make sure that you have this thinking when you're going through the thought process of, what is our crop mix going to be for this upcoming year? So that's at 167, 450. It's going to get us that returns to total cost equivalent to where our soybeans are at 1044. So what's that price ratio? It's 2.32. Just by way of comparison and kind of allow us to kind of segue into another topic, the Plc price ratio, okay, the government sign up. If you're signed up for price loss coverage, 840 to 370, that ratio is at 2.27. Now, this is one of the big things that is when they do finally pass a farm bill, what are they going to do? Well, everything that I've read and heard is that probably at most they're going to reauthorize something very similar and allow you to possibly, change your sign up. And what's going to happen is probably a lot of people will migrate over to PLC. And the other thing is that they're talking about is how are they going to change those target prices? Are they going to increase those slightly? Perhaps, it depends on who probably wins out in those arguments that they're having. So it's still going to be at 840 and 370. How's that going to change? So this is something, pay attention to as you're listening and maybe even giving input on the next farm bill. Talk to your legislators. All right, questions or comments? Further questions on this? Yes, sir.
Do you have in those numbers any value to a rotation versus just planting beans after beans?
As far as in the yield goes,
Well, bottom line, is your yield going to go down? Is the question. If you just keep planting beans.
we are assuming on both of those that it's a every other year rotation. We have not put anything together as far as the yield drag and extra costs associated with continuous beans or continuous corn. Certainly there's going to be something there. And that's some of the next topics that I'll address here. After we talk about these trend yields, we'll talk about some of these other mitigating factors. But here's the long-term soybean yield for Ohio. We go all the way back to 1970. Right here at 1970, this kind of blue line that's going up and down, that's the average Ohio soybean yield. That's the USDA data. Okay? So you can see this blue line. You can pick out some of the drought years in there. There's 88 right there. 2008 was a bad year. 2012, bad corn year, not so bad in terms of soybean yields. Here's the black line. This is the long-term trend. That's the number we're using in our budgets. You know, what are you going to be using in your budgets? Where do you start out with in terms of a price point if you're thinking about this? You know, APH yield, perhaps. That's not a bad place to start. You know, you may want to put in a little bit of a percentage increase for, you know, just trend. What are we looking at, though, in terms of shorter term horizons? This purple line that you're seeing, not so well here, but it's here. That's the 20-year trend yield. A little sharper incline. 10 years, this green line that's almost invisible, that's even sharper still. I've got the numbers here someplace. I had to jot them down because I couldn't remember them. Oh, do I have these someplace? 50 bushel is what we're using, 50.2. If we use the 20-year trend yield, it's 52.6 for 2018. If you use the 10-year, 54.5. So pretty big difference depending on what the term that you're using for a trend yield. So if somebody's just reciting this to you, make sure that you know what period that they're using for trend yield. There is not just one trend yield. Depends on the time horizon. So what are you using? What do you think out there? Should we use this long-term trend as far as our own budgeting purposes? Using a little shorter time horizon when you're thinking about this, probably. Corn, very similar scenario. You know, maybe not quite the same percentage that we're seeing in terms of the soybean change, but the shorter the time horizon, typically we're seeing a little sharper curve. There's other considerations as well. You know, I'm not an agronomist, but there are some benefits to rotation. You know, continuous soybeans, continuous corn, there are issues, obviously. So agronomic advantages for crop rotation are certainly there and will probably be one of the deciding factors that will keep most of you where you are now in terms of crop mix and crop decisions. Infrastructure, you know, for those that, you know, especially if we kind of point out, you know, certain extremes. If we look at Illinois, for instance, some of those farms have gone to almost, you know, continuous corn. We've got some farms in Ohio that have gone heavier corn over the last 10 years. Now, what have they invested in? Well, they've invested in a little bit more capacity in most cases. Probably a little bit more combine planting capacity, more semis to haul the stuff, storage capacity, maybe more bin space, labor capacity perhaps. You know, you got more volume typically. So some of this kind of locks you in too, as far as what your decision making is going to be. Now there's some ways that we're going to be making some decisions on those marginal acres. Do you make your crop choice based on that high yield point? If you're thinking this way, then I strongly urge you not to. Okay, that cornfield one time made 240 bushel to the acre. That's the yield I'm going to put into that budget. You know, sometimes we get locked into that thinking that, you know, that high price or that high yield point, just be cautious. You know, we tend to think in terms of corn having a little higher ceiling these days. I'm not sure. I've not really looked at the data to. Actually, I did try to look at some of the data, but I didn't really have time to see how, you know, what the percentage difference is from the average for Ohio average corn yield and Ohio average soybean yield. My first glimpse at some of this information showed me that there's really no difference. There's no difference there in terms of corn really having that ability to spike up higher. Now you may have some fields, some farms that you're saying, well, I had the ability to go to 240 on corn on that farm, but beans I've got this kind of glass ceiling. So I've heard that conversation at different Outlook meetings and other things that we've done. I'm not sure that there's really strong evidence to support that. I'll leave that to the agronomists. Sorry, soybean people, if I brought up a sore point of contention. But, that's something you heard probably, right? I've heard it. I'm probably, many of you have heard it that in certain parts of the state, not every place. Okay. Consideration given with regards to machinery costs. As we looked at those overhead costs, maybe we're not really considering higher cost of machinery between a corn acre and a soybean acre. Maybe you just kind of lump it all into the same category, and whatever we have left over after paying cash costs, variable costs, that's contributing to our total machinery bill. But, I would challenge you to think a little bit like that. Have an understanding of what the different depreciation costs are between a corn acre and a soybean acre. One other thing that we have that, should be considered, crop insurance is much better since the mid-90s than it was before the mid-90s, when we had the advent of, revenue insurance, and fairly cheap revenue insurance, highly subsidized. So we've got this kind of put, if you will, we've got this floor in place that's given us some, a little bit better risk management. So in some cases, it allows us to be a little more aggressive, I think, at times. In some acres, maybe that aggression would lead to more corn acres. Okay, because while corn maybe does have that upside potential that beans may not have, it also has a little bit more downside potential. A drought can wash them out pretty quick, where beans in some cases are a little bit more resilient, more defensive, at least as I look at the data. So that's something that I really haven't fleshed out. This is just kind of my first thinking about some of this stuff as far as how maybe, the psychology works in terms of decision making. But I think there's possibly something here. All right, switch gears, talk about cash rents. We really didn't see much change. For those that are producers, unfortunately, you probably are a little disappointed that you haven't seen more change in the system across the state. There are some areas that have seen a little bit of, relaxation of rents, but not much. Mostly flat cash rents in Ohio for 2017 and 18. Now, what are the fundamentals that we're following? You're all following the same ones, right? Margins are lower. These red highlighted pieces are the ones that I think are going to cause or try to cause rents to go down. The green ones are supporting them. Equity positions, we're burning through some net worth on average. Not everybody, but on average, we're using up some equity to survive these lower margin periods, right? Our county payments in 2018 are likely to be next to nothing. So these red pieces, they're going to put further pressure, downward pressure on rents. However, I think we're still, seeing the majority of the fundamentals that are supporting rents are a little stronger. You're seeing it in your own communities. You've got a number of competitors that would step in and take the land base that you have at a similar rental rate, maybe the same one. So we're all reluctant to give up that land base. Equity positions are still pretty healthy. This is one of the big things. Overall net worths, while weaker, are still historically pretty strong. Our county payments were solid in 16 and 17, gave us a cash infusion. Yields were relatively solid in 17. I know that wasn't the case everywhere in Ohio, but as a general rule, they were. And CAUV property taxes, this is what's got a lot of landowners that push back against any mention of lower rents. I think overall 18 is going to be fairly flat. 19, I don't see much difference. However, we're not going to have that infusion of government commodity payments in October. And there probably will be a few incidents here and there of someone walking away or deciding that's enough. Probably not enough to really cause wholesale changes in 19, but perhaps with the CAUV and property tax changes, the CAUV valuation changes that they passed earlier this year, last year, we will see perhaps some small relief in 19 overall. Land values pretty similar. We would expect to see a little bit more softness, but we saw some real strength in this market, especially on better ground, fairly flat in Ohio. Treasuries, kind of a measure of interest rates. This is that other fundamental that we're looking at pretty closely, is interest rates. How are they impacting land values and asset values in general? Well, if it hasn't already started to impact values, it's going to. At some point, interest rates will have an impact on land values. This is the 10-year Treasuries, around 2.87, almost 3%. What is the Fed going to do? We are soon going to, I don't know if he's been sworn in. Jerome Powell's the new Fed chair, succeeding Janet Yellen. Likely is going to be very similar types of policies, at least signaling like that. They've signaled that there are going to be 3 more rate increases in 2018. They did one just before Christmas. Another 3 would take us up 3/4 of a basis point, 0.75%. They're looking at all kinds of things. Employment's close to full employment, right? Economy's pretty strong. So these are signals that say, okay, yes, let's continue to raise interest rates. We're going to have to slow the economy down, or at least make sure it doesn't get overheated. But on the other hand, the other thing that usually accompanies these things is higher inflation, which we haven't seen. The CPI rate, typically the index that we look at the most, as of December, year over year was 2.1%. It's nothing to get too excited about. The core CPI without food and energy, 1.8%. So that's pretty bland. Now, since then, things have gotten a little bit higher. We'll see. We'll see how things play out here in the next few months. But they'll probably, in all likelihood, at least with the numbers that we're seeing now, they're probably going to raise interest rates another 3 times unless something dramatic changes, probably with economic growth. As long as we continue to see economic growth continue where it is, I have I'm pretty optimistic that they'll raise rates 3 more times. It's not a guarantee. There's also weaker demand for U.S. Treasuries. That's why that 10-year T-bill rate continues to go up. Costs us more to borrow money. Okay? And it's not really a reflection on us. It's more of a reflection on the rest of the global economy. It's just a little stronger. So there's other choices for people to put their money. Federal debt prospects, we're not going to go too far down that road because we can get pretty political on this. What's this additional debt going to mean to interest rates? Well, typically as an economist, you tend to think and teach about, well, more debt would probably mean interest rates are going to increase a little bit. There's a lot to be said as far as what's going to happen, however, with any cost cutting. They're not done yet, perhaps. Retail interest rates. What are we looking at here? This is the 7th Fed district. This is not Ohio. This includes Indiana, Michigan, all of our in West, Illinois, Iowa. They're surveying ag bankers in this district. Operating loan rates, percentage rates. The 4th quarter of 2016, 5.03. 4th quarter of 2017, 5.34. You've probably seen some of this show up in your own interest rates. What about real estate? Well, 4.71 to 4.93. I've even heard numbers, significantly higher than this in some of our own banks and co-ops here in Ohio. So we're seeing higher interest rates, certainly. And I would expect probably a similar increase in 2018. Now, all these factored together, what are land values going to do? Probably going to be, they're going to come under more pressure. Certainly these higher prices will lend support. There's going to be more support if we retain these high prices. But, the couple of other things that we throw in the mix here, this is the same kind of fundamental set that we're looking at for rental rates. But livestock and dairy income, that has to be considered. What are we looking at there? Higher interest rates, these are, I think, going to be negatives on land values. Phosphorus regulations, we've got some areas of the state that are really just competing for land, mainly to find a place to spread livestock waste. So some of those areas I know, and we're not too far from some of those areas, that have higher prices simply because of that. But overall, same kind of set of fundamentals, and I expect these to come under some pressure. Probably the average and poor ground will see a little bit more softness than the better ground, which we typically expect. All right, questions on land values or rents? Let's talk a little bit about tax legislation in the next 5 minutes or so. Real quick, brief, and you've probably already read, or maybe some of you are sick to death of seeing this on the news, but I'm going to try to summarize this as quickly as I can. We've got modified tax brackets. We've got more money that's going to be pushed down into lower brackets, and the brackets themselves are a little bit lower at certain levels. So this in itself is going to mean probably a little bit lower tax bill for many of us. They increased the standard deduction to $12,000 and $24,000, single and joint filers. However, with one hand they give and one hand they take away, right? They got rid of the personal exemptions. So this is perhaps, especially for large families, this could be a problem, right? So what did they do to then counter that? Well, they increased the child tax credit to $2,000 per child. So there's some give and take going on here, and there's a lot to be figured out yet. They eliminated or changed many deductions. Going to be many more filers that are going to just claim the standard deduction. This is the piece of the new tax law that is going to make it a little simpler. All right? It's simply going to be more people filing and using the standard deduction. However, there are some things that were taken out or restricted that has many people feeling a little anxious. This is one of the big things. This $10,000 cap on state, local, and property taxes. So if you were typically itemizing and you had a lot of these expenses, well, maybe limiting you at this point. Also, if you had a home equity loan, all that interest is no longer able to be itemized. Personal and casualty losses were eliminated as far as itemized deductions, except in presidential declaration areas. Charitable contributions, mostly left intact. However, it's going to take a lot more contribution to get you over that $12,000 and $24,000 standard deduction threshold to make it meaningful. So what's this mean? Well, maybe there's going to be a little less incentive to give to charitable organizations. Producers, many of you around the state are already doing this, is giving in kind. You can give in kind, make sure that those charitable organizations have the power to market it. They have to set the price point. But you can still give and eliminate it from your gross revenue. That's one way that you can kind of get around and still give and still get some of the tax benefits of giving. Most of the miscellaneous itemized deductions subject to that 2% floor were eliminated. Increased the child tax credit $2,000 for those above the age of 17, just when they're getting really expensive, $500. Okay, so maybe that doesn't make a lot of sense, but that's the way it is, right? Most of the education provisions were left intact. Alternative minimum tax. Individuals still have to worry about this, although they raised the levels. Businesses, or for corporations, they eliminated it. We still have an estate tax. However, for most of us, we're never going to have to worry about it, at least if this law stays in effect. Your unified credit, or your amount that you can pass to your heirs, either by gift or inheritance, is $11.2 million net. So if you're above that, yes, you might have to pay estate tax. If there's a married couple, there's still portability. So the second to die will have the ability to pass $22.4 million in net estate tax free. So that's really going to probably eliminate most farmers from having to worry about it. We still have this step up in basis. That was something that was argued about, but we still have it. The centerpiece, or one of the centerpieces of the legislation, corporate tax rates were decreased to 21%. Flat tax, it's no longer a set of brackets for corporate tax, which we used to have, and that's going to be a little burdensome on small corporations. The first $50,000 of C Corp earnings were taxed at 15%. So for those folks, it's an increase. But for everyone else, corporate tax, C Corps, it's going to be a decrease. Now, they had to make some concessions to all other businesses, or everybody was going to convert to a C Corp, right? So all other business entities, pass-through entities, sole proprietorships, partnerships, S-Corps, LLCs, all these other entities have the ability now to claim this Section 199A deduction, 20% of qualified business income. It's going to be fairly substantial. Now, if you're a high business, you have high business earnings, high net income, if you're above $315,000 in qualified business income for joint filers, there's going to start to be some phase-outs of this 20% deduction. This deduction is going to be taken on the 1040, not the Schedule F. So this is the part that's not so simple. This is the complex part of the new tax law, and you're not going to be able to put it on a postage or a postcard like they told us perhaps we would be able to do, right? Not going to be able to do that if you're a business. Okay? So there are some ways to still qualify. You have to have W-2 wages that you pay, or lots of capital assets, or a combination of the two, and you can still qualify for parts of that. A couple of other things, other details here. I'll come back to the co-op thing briefly. First year bonus depreciation, 100%, at least until we start to get close to the sunset of this tax bill. That's part of the problem is at the end of 2025, many of these things sunset. So they're going to have to come back to the table and renegotiate, or many of these things will go away. Section 179 expensing, $1 million. Farm equipment depreciation, now 5 years rather than 7. NOL is limited to 80% of the taxable income. You can only carry it back 2 years, not 5. Like-kind exchange retained for real property, not for equipment. So when you trade in equipment, that's a taxable event now. You're going to have to pay tax on the gain. It's not going to be, you won't have to pay self-employment tax on that transaction. So it may in effect be a benefit to you. You're going to be able to expense the entire amount of the purchase. So it's going to be mostly a wash. Equipment trade-in will be a taxable event now that you have to track. Cash accounting was retained. The big controversial piece was the Section 199A deduction, additional deduction for co-ops. Originally, that language was supposed to be a 20% of gross of patronage dividends, but they also included language that allowed per unit retains to be included in that. So from everything that I've read and I know, it was an unintentional language that was included. Maybe you have some inside scoop that will tell you different. Since they've really discovered this, they're trying very hard, very diligently to get language into another piece of tax legislation that will undo that 20% deduction that co-ops get on those payments back to their members, that essentially gives those folks about a 5 to 25 cent per bushel advantage over privates like Cargill and ADM. So if you haven't already tuned into that, that's about what the difference is. So stay tuned. I think with this omnibus spending bill that they're going to have to pass here by the end of March, what I read in the last couple of days is they're going to try to put language in that to get this language corrected. Now, whether it's going to be retroactive, the attorney or two that I've talked to said if they try to make it retroactive, it could be lawsuit heaven. So there's even now some controversy on whether or not they're going to be able to make it retroactive the first of the year. So many people have already made decisions, I think, based on that. So, okay, I am done. I'll be happy to share my slides. My email address is here, so you can send me an email if you want my slides, and be happy to share them.